At Annuity Straight Talk, we advocate a flexible strategy with our clients to achieve safe, protected growth, free from market volatility that supplies guaranteed income and above all avoids lifetime locked-in commitments and keeps your options open for the future. We think this makes the most sense in a volatile market where rates are low and always threatening to move up. You need to stay protected and safe with your money, and frankly, there is no better tool in the market than an index annuity to do this. The problem is, most advisors and most consumers only know about index annuities with lifetime income riders, or hybrid annuities, which are sometimes abbreviated as GLWB annuities, for guaranteed lifetime withdrawal benefit. It seems as though the whole annuity industry pounds the guaranteed lifetime income drum, but the solution they offer, a fixed paycheck for life, isn't really all that smart. Locking in a lifetime income today just locks in these historically low rates forever. Is that really what you want? If you've been shown one of these hybrid annuities, sometimes sizzled up as the hybrid income annuity plan, then most likely you have seen a piss-poor underlying contract with low growth, overbundled benefits, and high fees. This is what I call a lifetime locked-in commitment, and it's almost always a bad deal for you. Many consumers, and indeed most annuity salespeople, are simply unaware that simple, safe, and stable index annuities are even available without the income riders. I hear it all the time. But in many cases we find these to be the perfect solution in most portfolios. In this video, I'm going to show you exactly how these index annuities work and help you see the truth to cut through the mixed marketing messages you might have seen previously. It's also important to note that there are over 350 index annuity contracts on the market today, but most advisors only know a few of them. The best ones that we like are very different in their underlying terms and performance than the ones used with income riders. I'm going to show you exactly how. So it should be crystal clear now. While I think hybrid annuities with the income riders are not such a great deal for most people, I do love index annuities and know they are a great deal. So I want every one of you to understand the difference between these two. I'll show you exactly how they work and what to expect, and I'll show you all the details that separate good contracts from bad. So where do you use an index annuity in a portfolio? Think of the index annuity as an alternative to your bond holding. It's a core, safe, stable asset that will grow if markets grow, yet unlike bonds, the annuity will not lose money. The annuity forms a rock-solid base that provides you with a place to withdraw from safely for income, and it allows your other assets to be invested more aggressively for growth. If your market investments are down, you can pull money from the annuity to allow your investments time to recover. If your market investments are up, pull from them and leave the annuity alone. And following our flex strategy, if an index annuity makes sense for your situation, we position just the right amount of your assets in only the best contracts with the shortest possible surrender schedules to leave you in total control of your money. So let's dig into these deceptively powerful index annuities to understand how they work for you.
Okay, welcome to the brief tutorial from Annuity Straight Talk on index annuities, how they work, and how to choose the right contract. First of all, a fixed index annuity really is just a contract with an insurance company like any other annuity. Like any insurance contract, you're just going to pay the premium and the company is going to commit to take on certain risks. In this case, the risk of losing money is carried by the company. With these contracts, what you do is you buy guarantees that state your account value goes up if the market goes up, and it does not go down if the markets fall. Sound too good to be true? Well, it's not. It's actually pretty easy, very simple. Moving along here, what happens with your assets is the company invests in bonds, mortgages, other safe investments just to produce a nice, stable, even yield. And those assets are held in the company's general fund. It has the same basic structure of a fixed annuity with a guaranteed rate of return. Okay, in today's market, that the yield is, once the insurance company takes out the cost, the yield's about 3%. So on a $100,000 premium, you have about $3,000 per year to work with. Where a fixed annuity would just credit your account with the $3,000, the company instead uses those interest earnings to purchase options tied to a market index like the S&P 500 or the Dow Jones. Okay, there are a lot of different indices used by different companies. Some of you might never heard of, but for simplicity purposes in this tutorial, we'll just stick with the simple ones, S&P and the Dow Jones. Okay, so basically, an option is a wager or a bet. If the market goes up, the option makes money. If it falls, all that is lost is the option price, which would be the $3,000 interest earnings. Okay? If there is a gain from the option, some percentage of that gain is credited to your account, And if the markets fall, you have invested nothing in the market directly, and therefore you lose nothing but the option consideration. So you are not involved in the market, so there is no risk of loss. Every insurance company has a stated method for calculating the interest earnings on the contract, and it starts with the crediting method, okay? There are a lot of different methods that vary based on specific contracts and insurance companies. So you've got monthly averaging, annual point-to-point, multi-year point-to-point. We talk about those in greater deal elsewhere and to some extent in this presentation. So those are the most common ones. Crediting methods have a start and end date with an associated profit or loss in the chosen index. And that's going to tell you whether you earned money or stayed flat for the year. Okay, so the big question is, how much do I get if I only get a percentage? Okay, the growth is going to be either capped at a certain rate, or you get a certain percentage of the yield, or they take a fee off the top. And those are expressed with terms like the cap rate, a participation rate, or the spread, which is the fee. Okay. A lot of people say, it's a ripoff. Why don't I get it all? Well, growth is limited, but there's no risk involved. So the insurance company can't necessarily afford to buy an entire option with your interest earnings, so you get a proportionate share of what's available. So there's the trade-off, no risk, but you have potential for gain. You're obviously not going to get all of it. If you want all of it, go to the market and take on the risk. Okay, the insurance company takes the risk, and what they can afford to pay you, they will. So looking at all of those in more detail, starting with the cap's participation and spread. The cap is basically a maximum amount of interest you can earn. Okay, an example is if the market goes up 10% with a 5% cap, you get 5% because that's your cap rate. A participation rate is a percentage of the index gain. So same example, 10% gain with a 50% participation rate is the same 5% gain to you. So in that scenario, either one of them is about equal. All right. The next one is the spread. It's a percentage of the index gain, or a percentage taken from the index gain before interest is credited. For example, let's say a 2% spread. In a lot of contracts today, this offers the highest earning potential in certain years. Okay, so this is becoming very popular. A 2% spread means all of the interest earned in the S&P 500 minus the spread. So in great years has significant potential. If the S&P goes up 20%, they take 2% off, you get 18%. Yes, that does happen and can happen. Okay, it is sometimes also paired with a participation rate. It can get kind of detailed. Obviously, with all of these things, you need to know exactly what you're getting into. So the example is a 10% index gain in a contract with a 70% participation and a 2% spread. You got 70% of 10%, which is 7. You took off the 2% spread, you got the same 5%. So we kind of settle these numbers so they end up at the same point. However, all these different methods and pricing controls are beneficial in different market scenarios. So that's where the decision factor comes in. Okay. If you're looking at buying an index annuity, there's 5 key decision factors that you need to look at, okay? Surrender schedule. What's the time that you're going to be in the contract, and does it work with your parameters and what your time frame is for your other plans and goals? The growth component, that's going to include cap, participation, and spread rates. There's a guaranteed minimum on every contract, so you want to know what the worst case scenario you're going to get back. And obviously, if you can, look at back-tested historical performance rates from the company. But the growth component just tells you how much money you can expect to make. What's the potential of the contract? Okay. Also, the free withdrawal provision is very important because that's going to show you what kind of flexibility you have with those assets while you're in that surrender period. We'll go into detail on all of these. And again, kind of along the growth component, what's the renewal rate history for the company? Do they give you high rates for the first couple of years and then drop them? Or do they have pretty solid, stable history of keeping the rate steady where you got them? Okay, you need to understand all the terms in the contract, but this really is, the whole presentation here is just about showing you the things you need to consider, and then when we look at a specific contract, it'll all make sense to you. Okay, and then obviously the big one is the carrier credit rating. Don't you want an insurance company with high ratings? There's a lot of things I could say about this, but why not? Let's stick with the good companies. There's nothing to gain by going lower. So starting from the top of those with surrender schedules, let's talk about these in a little more detail. So in addition to the cap and participation, there are other terms of the contract. The big one is the surrender schedule. There's no upfront cost to you, but it is a charge for canceling the contract early. And in the mutual fund world, there's similar charges, and it's called a contingent deferred sales charge. It's like a B-shared mutual fund. Okay, no upfront costs, but if you get out early, then you got to pay them back. So the company basically gets its money back through cost of placement if you cancel early. They got to sell bonds early. They might take a hit on that. They ate the agent commission. They're going to take a hit on that. So they need to hang on to your money long enough to get their money back. And if they don't, then they need to charge you for it. Okay? But the surrender schedule's got to match your strategy for your time horizon. If you have a 10-year plan, don't take a 15-year annuity because it's not going to work for your 10-year plan. Okay? Our feeling is the shortest contract with components that match your strategy is going to offer the most benefits because it's going to give you all the components that match your strategy, plus you're going to be more flexible because it's got a shorter surrender schedule. Okay? Moving on to the growth component, this is really important for understanding the potential of the contract. You want options that suit your preference, okay? Some want simplicity, like the S&P 500. There's nothing wrong with it. Others like a wide variety of indices that some people would find too complex, but they like to have the options for more. You can adjust the crediting methods and allocations on an annual basis, so you want to have the options that you like. If you don't care and you want something simple, the S&P 500 is a great way to go. But if you want the Hang Seng and the Nikkei and the Barclays and the this and the that, you can find a contract that'll do it. So also the participation caps and spreads they're definitely a personal preference. Some want spreads, some are okay with a cap, some want a participation rate. It's all personal preference. Once you understand the contract, you'll be able to determine exactly what makes sense to you and what you like to chase. The big one here that we talk about a lot is the free withdrawal rate. Okay? It means how much you can take annually from the contract without penalty. It can be used for drawing income or laddering investments. You can pull a little bit out and put it somewhere else. Okay, it's most always 10% per year is very standard. Sometimes it's offered during the first year and others not until after the first year or sometimes after the second year. If it's less than 10%, there's usually a trade-off. It might give you a little bit better growth. It might be a shorter surrender term. But you need to understand what the potential is, and if that lower withdrawal works for you, then you can take the higher potential contract. So it's situational. It depends on you and what you want. It's definitely not for anyone. Okay. Renewal rate history is something you can't always find. It's not always easy, and most agents aren't going to offer it to you. Okay. You want a company that holds rates steady. All right. If you start with great rates and the company drops them after the first year or two, then the contract isn't going to work out as you had planned, or definitely has less of a chance. Some companies will publish rates, others don't, and some we have personal history with, so we know firsthand whether it's good or bad, and you want to stick with a company that's proud of their history. If they don't publish it, there's a reason why. Easy one there. So on to the last one, the carrier credit quality, the financial strength rating, and the assurance company. So this could be a mid to long-term bet. No reason to go with a lower tier company. It just goes without saying. Okay, safety is first priority. You want better terms, better service, better history. Stick with the best companies. So there are some advanced terms and provisions that have evolved in recent times. So it's going to change on a daily, monthly, annual basis. It can be extra homework or can be saved for a more advanced discussion in a personal setting. There are alternative indexes or indices. You get to, like I said, the Japanese index, the Chinese index, the European, the gold, all sorts of stuff. There are tons of different options. Market value adjustments. There are ways that the insurance company can adjust the value of your contract at surrender when you take a withdrawal. Long surrender penalties. A contract that has terms make you keep your money in there for a long time. There's got to be reasons why, okay? Some of them go as long as 20 years. It's crazy. So the same with long crediting periods. If you reset more than, usually they reset and you lock in gains once a year. Sometimes they're 2, 3, 5 years. You need to know why. And obviously the uncapped strategies look great. They're sold as great, but there's always something a little more hidden in there. Doesn't mean it's bad, but it depends on, first of all, you understanding what you're getting into and whether the terms of that contract work for you. Okay, on the top of that, the alternative indices. So different types of indices offer various opportunities for good performance. As I said before, some people like variety and others like simplicity. It's easy. Your preferences are going to dictate the decision. And if you choose an alternative index, you've got to understand the terms and you've got to know what it means. And obviously testing historical performance and historical performance relative to the other indices is a great place to start. Market value adjustments. This is one that we see a lot now. So a market value adjustment changes the value of your contract based on changes to interest rates over the term. That can be positive or negative. It's just like a bond. If you own a bond and rates rise while you own that bond, the market value of that bond is going to decline, okay? Because it takes a lower premium to create the same par value at the end of the term. In the same sense, if you own a market value adjusted annuity and they say you're going to get 3% for 10 years, you lock in 3% for 10 years, going to grow to about $100,000 to $135,000. If it's a market value adjustment and a contract and the rates go up a little bit, then your 135 is now going to be 128. Okay, they sometimes apply it to only to early withdrawals, sometimes to surrenders. Okay, but a lot of income contracts, especially, have the MVA, market value adjustment feature, and that substantially decreases your flexibility if rates go up. And in the past, when rates were high, as they dropped over the last 10 years, we've seen that market value adjustment be positive. It was a good thing. But with rates really low, there's not a whole lot of upside because they can't really go lower. And if rates do rise, then you're going to take a little extra hit there. So the basic idea is you're going to carry the interest rate risk, and we're trying to talk about safety. So why carry any risk? Because there's not really a whole lot of payoff there. You just have to know what to look for. Long surrender periods. This one's really easy. It's a high cost for the insurance company. They got to pay a big commission, and they've got to hang on to your money for a while to make their money back. If not, they're going to charge you heavily for it. Okay, the surrender penalties are going to be higher. So there has to be a solid and very obvious reason why you would want that specific contract in order to stick your money there. So otherwise, just find something else. You got to determine for yourself if it is in your best interest. If it's not, like I said, go somewhere else. The numbers suggest on the contract components, surrender charges, add up all the factors. I think 7 years is kind of the sweet spot. 5 to 7 is good. 10 can be okay. And if you have the stomach to keep your money there for 10 years, you can get some good benefit. Longer than 10 years, it usually isn't a fit, and I don't really see much of a benefit to sticking your money there for a long time. Most people are going to want to reposition or do something else after that time period. Okay? On the next one, long crediting periods. Extended crediting periods definitely deserve some closer scrutiny. And it can normalize. There's a benefit where it can normalize market volatility in some cases or help capture a greater yield on a long market upswing, but there's a risk to it as well. You can miss market growth if the credit period hasn't expired yet. Means if the market goes up really well and then it tails off or drops before you lock in gains, you could instead add a market correction that reduces or eliminates the yield. So the longer time period simply means that more can happen, good or bad, while you wait anxiously to lock in gains. Okay? It's up to you and what your feeling is of how the market works and what really what the strategy is for those funds if they can handle a little more variability in the yield. Okay, and a big one that's really popular today, the last one, uncapped strategies. Usually require a detailed explanation that is rarely given. Okay, you could have lower participation rates, higher spread rates, or required blends. What a required blend is, it'll say you have an uncapped strategy, unlimited earnings potential. But the example is you're required to have your assets placed in an option that is 60% of S&P and 40% in a fixed rate of 1.5%. That's kind of a sneaky way to offer a 60% participation rate. So 40% of your assets are going to get 1.5% and the other 60% are going to get the S&P. They're calling that uncapped, but it's obviously capped. I don't even understand why they can market that and they haven't gotten in trouble for it yet. It's shady. Okay? So these may allow for more growth potential, but there is a trade-off. There's always a trade-off. And so you need to, when someone says uncapped, unlimited earnings potential, there is a reason why. Look for it. And if you can't find it, call me. I will tell you the truth. Okay? That kind of sums up the basics. There's how index annuities work, what you need to look out for, and how to choose a good contract. There's a more detailed tutorial, a good presentation we have, a link to it on the website. If you have trouble finding it, you can get a hold of us and we'll certainly email it to you and have these more detailed conversations later. I appreciate your time. Thanks so much for showing up and have a great day.
So there you have it, a thorough and complete analysis of index annuities. These incredible financial tools offer you the ability to go up with the markets but never lose money. And when you use them the right way, like we do here at Annuity Straight Talk, you can build a customized, flexible strategy that gives you the ultimate in control, profitability, income, and legacy. Index annuities are too often bundled with complex income riders that drag down an otherwise great product. But don't let uneducated advisors or uninformed commentators in the media steer you wrong. Instead, make the smart choice. Get started with Annuity Straight Talk today. Just visit us online and set up a time on our calendar so we can get going on your flex strategy now. Make an appointment to get started. I look forward to working with you soon.